Alan. That was great. I want to thank everyone for joining us. We have our guest speaker who also has joined us, Laura Geritz, CEO for Global Rondure, is here with us, and I'm going to go ahead and give it away to her. So, Alan, if you wanted to stop sharing your screen.
Yes, ma'am.
Perfect.
Great, because I won't be. Hi, how are you?
Good.
You know me, I'm not very tech savvy, so my Zoom screen skills are weak. But I will say, Alan could have basically. Our process is Alan's process. That is exactly how Rondure looks at stocks. Just for you guys' knowledge, I'm 20. I'm a 22-year industry veteran. I started in the industry prior to the tech bubble. So I watched the tech bubble blow in the United States. And I've been doing emerging markets and international and frontier markets for years and years and years. We look for two things, I guess a couple of things. We do proprietary screening for quality. So there are certain factors in terms of quality that I think maybe I can almost answer every single one of the questions on the stocks that Alan went through from experience of covering them. But we look at, first and foremost, balance sheet quality and cash flow stability in terms of thinking about, is the company special? And we screen bottom up, and we do it for every company in the world. And there's approximately 70,000 of those, from small cap, emerging, and frontier to Terra caps in the United States. We tend to narrow down our companies on that, on those parameters. And then the next thing we do is we look for their future compounding capabilities, and we do that by analyzing Warren Buffett's good old moats. Except we actually have our own proprietary process for moats, which I've got a scoring framework here that I can show you how we think about good companies. And you can take this scoring system and you can do it with every single one of these stocks that you just went through. Basically be able to score and figure out some of the attributes of these companies. But let's see here if I can share screen. This is our moat process. It's called Club Glue Platform. And just maybe I can start off with Microsoft versus Verizon, but we're looking for companies that, number one, are a club, so they either dominate their markets, and those markets are really tough ones for others to penetrate because they're so dominant. They're platform businesses, so they control a valuable network. I think, in today's terms, we usually think of these as technology companies, but they can also have a distribution advantage like McDonald's. And then, then you have glue, benefit from loyal and captive customers, or hard companies to disrupt. We, generally speaking, like to look for companies that have at least two of these attributes. And just to get back to Alan's commentary, the one that will let you know whether a business is most likely to compound or that you need to be very, very careful on price is the glue. If the customer is cyclical, if the products are cyclical, if it has a weak glue score, then you better be careful about what you pay. And the perfect example of that is Carnival Cruise Lines, which, I'll get to the next page, but, sorry. This is a Word doc, let me back out. Sorry. Sorry, I was in a rush today. We've had an incredibly busy earnings season. But this is sort of how you think about clubs, leads, and platform businesses. It's a really, really quick cheat sheet. You have clubs, they can be low-cost leaders. Sorry, I'm trying to go through the models in terms of who's a low-cost leader on your spreadsheet or on your company list. You can have asset monopolists, Disney, Coca-Cola, McDonald's in some respects, Microsoft for sure. By the way, the reason Microsoft is outperformed, sorry, I'll get back on. Glue is, you can also have efficient scale players. I don't see any efficient scale players on your list, but an efficient scale player would be one that dominates like a really tiny little niche. It could be like a local bank that just has a dominant niche, or sorry, I'm trying to think of other US companies that maybe fit that bill. In our world, it's drugstores, or there's a soil in Japan. They're each very regionally dominant. There's no one big national player. And then also in Hong Kong, there's a very dominant soy milk player. Just think of it as like the Beyond Meat of Hong Kong. It's super like big thematic play on healthier eating habits, but it's much cheaper than that stock with probably equivalently good growth potential. In terms of glue, we are looking for benefits from loyal or captive customers. So what forms can glue businesses take? Must-have products. So Microsoft is a glue. Why is Microsoft a glue? Because I wouldn't be sharing this presentation with you right now. Every single one of our IT, just think of our business suppliers, of IT companies, etc. Sorry, all of us as businesses, we have to use Microsoft. We have no choice. So it has been a really sticky business. You don't see a lot of cyclicality in earnings because of that. They do have a couple of cyclical businesses in terms of their sort of legacy console businesses like Nintendo, and their legacy hardware businesses. But by and large, their software is very sticky. I think you could probably say the same thing for Verizon, except I will give you why I think Verizon has underperformed. There are two reasons. We go back, and if you look at this club attribute in the telco space, the government is the club. It's, even though these are dominant players, that you can get surprised by regulation and just blown up in the space technically. And then if I were go back into our screening process, Verizon has a net debt balance sheet. Microsoft's balance sheet is better than any government's balance sheet in the world. It is a spectacular balance sheet, which gives them all kinds of flexibility to buy back their shares, increase dividend yields. That is another form of margin of safety, that balance sheet, that compounding capability, that moat that generates EVA over time. Last but not least, we'll go to platform, which platform can take a lot of forms. A platform can take a logistics and distribution network, a scale advantage, so that could be McDonald's. It can take the form of a communication or social network. I think those are obvious in the world. You know, that could be anything from Facebook, social networks, to Google, to Amazon, in terms of platform advantages. And then again, marketplaces is another platform advantage. So we take a scoring process. Sorry, I'm so sorry. I had to use Microsoft. So sorry, Word. So it forces me to screen forward one page. So this is our scoring process. We take a 9-point, a 0 to 3-point scoring process, and we score the club, the strength of the moat in terms of defensiveness of the monopoly or oligopoly or efficient scale advantage. We score the glue. So how sticky is this product? Again, one of the reasons like Carnival has less sticky customers is because by and large, I don't know if you guys know this, but most people finance their cruise, and most people are still paying off their first cruise when they take their next cruise. So outside of COVID, when the credit market contracts, that can really affect who is taking a Carnival cruise. Outside of just, let's ignore COVID and just think about what is the CGP here when when you don't have COVID. But again, it's a great club industry. There are only 3 players in the world. You know, Disney has a really tiny cruise arm, but it isn't big. And then last but not least, we score the platform as well. One thing I will point out to you back again in terms of Alan's cyclicality question and long-term compounding is outside of bad balance sheet or overvaluation, you still have to watch what you pay for these businesses. You want to be careful. The number one factor that makes you have to be sensitive on price is glue. Going back to Nintendo and Disney example, Disney outside of COVID is a free club, a free platform. And as you guys all know, because they bought 20th Century Fox 2 years ago, it is a much stickier business today because that direct-to-consumer distribution platform is just much less cyclical than the other two pieces of the business. I think they're at about 35% operating capacity on the park side of the business. So it technically the glue is improving because of that network or direct-to-consumer business. So what was a lower glue rated business at one point in time has really increased. On Nintendo, I totally agree. It's probably a 3 club, 2 to 3 club, and maybe a 2 to 3 platform business. Disney's fallacy and why it hasn't performed very well, and they're trying to fix this right now. Sorry, Nintendo's. I've met Nintendo many, many times. It's a Japanese company. They're very conservative. And one of the things that they do is they hide their console is this golden profitability goose, and they don't want to kill it. So one of the things that they have not done well is they have not monetized their IP. There's no reason that Nintendo should not be monetizing the heck out of, Mario Brothers. I think you see the first attempt at them doing this right now with that new, I don't know if you guys see the new racetrack game they're doing right now, where you can buy Mario, and they're trying to monetize their IP better. So they're trying to create more products and goods around their IP. And then in addition, they're also, I don't know if you guys know, but in terms of the video game industry in general, most of them are creating subscription-based platforms right now, which has a sticky Netflix-like monthly fee. Nintendo has had record subscribers on this platform, but it's really low fee right now. Just like Disney only charges, by the way, $20 in India and Indonesia for Hulu Plus, and basically Nintendo is doing the same thing on their gaming platform. So is Microsoft. I think Microsoft's is like $10 a month. Apple's is like $10 a month. And the whole goal of these companies is to try to mute the cyclicality of the product cycle, and to monetize their IP. They also, I don't know if you guys know this because of COVID-19 has shut down the theme park, but Nintendo now has their own theme park in Japan within Universal Studios that is like a Super Mario themed park, and that is an attempt to monetize their IP as well. So they've done a horrific job in the past of monetizing their IP, and they're really trying to take a step forward because it would increase that glue score. That's about it. You can do this with any single company. If you have a weak glue score, be very, very careful about chasing momentum. You still have to get the balance sheet right. Verizon has a weaker balance sheet, and again, the company might be, the government might be a regulator, they might be the club, so that might disrupt Verizon. So you can, and again, Southwest Airlines has weaker glue, and having been experienced through Abercrombie and Fitch in the 90s, apparel, fast fashion, big box apparel is very, very cyclical, weak glue. That's about it. But you can use this on any single company. It's really simple.
Very cool. Thanks for sharing that with us, Laura. I want to open it up if anyone has any questions for Laura. You can either type in the chat or unmute yourself.
I do have a question, but I don't know. Because right now I've been looking at, I've been trying to research some stocks that I could possibly invest in. And something I've had a difficulty finding is, how do you find a moat in small stocks before they have gotten the time to flourish?
It's easier in international. It's really hard in big economies. It's really hard because the US is such a big, big economy that, by the time good businesses tend to go up the cap spectrum because, again, it's a big economy, lots of, total, you guys all use TAM, I don't, but, there's a huge total addressable market. So that means they tend to get big if they're good companies, if they're moated, they're good. The only way you can do that in the US really is to focus on those efficient scale players that I was talking about. So maybe like a regional monopoly, something funky like this one stands out to me, but you have some of the regional convenience stores stuff like that. Not super exciting businesses, but they do have a moat. And if you time them right, but it's hard. It's much easier when you do international because emerging and frontier economies are really small. They're nascent. So you can find really, really good companies in the small cap space that have moats. Just to give you an example, New Zealand is a country that only has 3 million people. The eBay, the Amazon, it's been taken out now, but the eBay, the Amazon, everything, the Yahoo, the Google, everything, Facebook of New Zealand, because it was only 3 million people, was trading at less than $1 billion market cap. So that's easier. China's hard now because the economy's gotten really big. So down the cap spectrum gets really dangerous.
All right. Thank you.
Thank you.
Laura, I have a question in the chat. Eliana wants to know, which specific companies do you think are the safest to invest in right now during COVID?
Oh, wow, it's tough because it's so tough because you've had a really, really, really big flight to safety trade happen, right? You've got flight to e-commerce because everyone sort of shifted their purchasing habits to e-commerce. You have, all these trades, you have a flight to healthcare. Healthcare in China is like through the roof because everyone's camped out there. Glove companies, they're camped out there. Clorox, look at Clorox stock. It's like straight up, right? Because everyone's been buying disinfectant. The paradox of that might be, and I think you guys all saw this, right? Last Monday and this Monday when the vaccine news came out, the safe stocks may not be very safe right now. So what may be better to buy is those weak blue stocks like Carnival that have a recovery story. Now that said, the balance sheet there, is still like they've had to take on a lot of debt like during this environment. So from our perspective, like it's a harder stock to buy. Some that we have, and even the Disney of Japan has a they have a net cash balance sheet. It's the most visited Disney on the planet. It's called Oriental Land. It is they literally have 10 years of cash on their balance sheet. So the world could shut down for like 10 more years, and that stock they'll survive. But the problem is because of that, the stock has done really, really well because people are like, well, it's fine if we have a worsening COVID landscape, and it's fine if consumers come back. So we would tell you it's one of the most difficult environments I've ever seen, maybe since '99, because what is safe is expensive. And the COVID recovery stocks, we all saw that was a 15 standard deviation event, what happened last Monday when Pfizer made that announcement in terms of momentum's underperformance. So it's tough. It's really tough. And I don't have a perfect answer. So our answer on our strategies has been barbell it like mad. Own some COVID safety stocks, the healthcare, the e-commerce with good balance sheets. Microsoft is another one. And then, own the recovery stocks. So just barbell, which it sounds like most of you guys are all doing anyway. So.
Awesome. Does anyone else have a question?
I have a question. It kind of flows into what we were talking about. So with stocks like American Airlines and how we were talking about Carnival Cruises, I notice like whenever there's recession periods, they always drop dramatically, but they always increase. But that increase usually has a cap. So do you recommend investing and just taking out the money sometime in there, or should we just kind of stay away from it and try to really go into value stocks?
Well, what's so hard is back to the COVID on, COVID off sort of trade, or let's call it risk on, risk off. But what's been traditionally risky in a recession this time is not necessarily, what's been, so contrary to popular belief, e-commerce stocks actually are consumer discretionary stocks. So the stuff that people purchase on an e-commerce platform may be cyclical. Why Amazon and why, sorry, I'm getting off on a tangent, but why Amazon and why Walmart all want to do grocery is because grocery is not cyclical, and grocery is, in terms of the consumer's wallet in the US, it's about 4 times the size of what Amazon and Walmart have traditionally catered to in terms of just consumer wallet. I mean, food is a big ticket item. It tends to be really counter-cyclical because I don't know, they call them SNAP now, but it used to be called food stamps. but you can use that online now. And that also tends to be very, the glue tends to be really sticky, because when you get a contraction in the economy, that's revenue that you don't lose. Long story short, sorry about that. I've gotten off the tangent from Carnival. I mean, I think COVID took us all by surprise, right? I mean, who would have thought that the demand would have, contracted like that? We were in a pretty good cycle. So my assessment is that probably right now, since it is very weak glue, in terms of cyclicality, you probably have a pretty good recovery story there. But if there's any sort of fear of COVID going up again, multiple years of no cruises, then it just doesn't have a great balance sheet. And, it's really sad, because if you look at the founder of that company, who's been around for years and years and years, and his actual holding in the business, I mean, for all, everyone thought that was the better balance sheet in space. So, I mean, in terms of like ranking, you've got the best balance sheet company. The problem, though, that I see is the industry's so consolidated now that I don't know if you guys noticed, but in the past, when the cruise lines would have a bad cycle, they just sold ships they could sell ships to the better balance sheet. No one has a balance sheet that can do that right now. So that's a really tricky landscape. So my commentary for you is maybe it's not your best long run stock if it bounces a lot. I've made the same mistake. So, on a club and platform basis, it's exceptionally good. The balance sheet is just iffy. Their assets are very good, but it's very, very cyclical. And the stocks did that back in going back in time, thinking about why that you had some of these cycles. Some of them, if you go back in time and look at the charts, that's probably 9/11 in the charts. So just kind of look back at that 01, 02 period, and that's a pretty good parallel for what could happen.
Thank you so much.
No, thank you. I was shocked. Your presentation was fantastic. Sorry, I don't mean to be shocked by that, but it's better than ours.
Does anyone have anything else for Laura today?
Laura, this is James. I couldn't resist.
I didn't know you were
I couldn't resist hearing Laura Geritz talk about what makes a great business. So I had to dial in. How are you, Laura?
I'm great. How are you? What do you think of these? What do you do here?
In these markets? Yeah, it's been, like you said, it's been killer, this rotation out of quality into cyclicality. What do? We stick to what we do, right? We own quality businesses, and we are not going to outperform in every environment, but we're going to stick to what we do. I think there's good secular growth trends, and so there's lots of good secular growth opportunities opening up, but it's tough. Yeah, we've been hit hard as well on relative performance.
Are you?
I have a question for you, Laura, because this is your time to be on the spot. How do you think about valuation in today's world? So, on one hand, companies are expensive, especially on an earnings basis. But on the other hand, when you look at low interest rates and implied discount rates and low inflation staying low potentially for longer, valuations could continue to just rise and rise and rise. And so how do you think about valuation?
The stronger the CGP, and the more the interest rates are Japanifying. As you guys probably know, I lived in Japan off and on all my life, so I'm a student of deflation, unfortunately. Either fortunately or unfortunately, I have the sort of deflationary playbook from Japan, maybe now Europe. But for sure, if you think about it on a Warren Buffett basis, Warren Buffett said it better than anyone. He hasn't followed the playbook as well as his own, what he says about, in a 1% interest rate environment, a company can sustain 100 PE. you know, for if it grows, you know, the inverse of the, you know, the earnings yield, you know, is still 1%. And if it grows, you know, next year it'll be higher than 1% and the next year. So, I mean, that has definitely been playing out in Japan, right? I mean, we see the higher the secular growth, the better the club and the glue and the platform, then the more that you're seeing stocks actually go to those 100 PE levels. And in my opinion, you're an emerging markets person, so am I. I see no inflation in the emerging world other than just supply chain disruption. It's deflationary or disinflationary at most. So I think interest rates in emerging are headed straight down to US levels. I think the US has boxed itself in. It is now Japan. So yeah, stocks are way better than bonds, in my opinion. They're going to be volatile, but you know, on an earnings yield basis, then, you know, as long as interest rates keep coming down, I view the, you know, the price that you pay is somewhat of a bond proxy or spread to bonds, and bonds are terrible. Bonds look terrible to me here. So that's, yeah, I think it's really challenging though, because the more and more you're like digging into your models, the more you're having to justify returns with a higher PE, which for me, you know, that's shocking on an absolute basis since I've seen multiples so low, but it makes all the sense to me in the world given bond rates. And the average bond rate around the world, including emerging, is 1% right now. With developed markets, I don't Nestle India or Nestle Switzerland all day long. You have a negative 1% bond yield there. And the Swiss currency is rock solid. So sorry, that was a long-winded answer, but it is really complicated.
Yeah, no, I hear you. I think you're right. I mean, it's all relative, and stocks still look on a yield basis more attractive than bonds, but it gets hard as a portfolio manager to put a 30 times earnings, 40 times, 50 times as a target price, and you know, keep pushing yourself up.
I mean, some of the emerging markets, at least, you could argue there's been, you know, there's no middle class consumption right now, except in China, by and large, right?
Yeah.
So maybe some of I find myself justifying like, well, if you ever get a mass consumption recovery again, then my earnings are on trough levels. But I mean, that gets harder and harder to justify. But as we both know, like when you look at India and the car market penetration is like 20 cars per 1,000 people in India versus like 800 cars per 1,000 people in the US. The long run growth story is great, but it's hard. So and all of our best performing stocks in the last few years anyway have been the ones with the eye-popping multiples. So
exactly. If the company's delivering, the market will pay what it needs to pay. All right. Well, thanks, Laura, and thanks for doing this. You're amazing.
No, thank you so much. What you've created is spectacular. I love watching these young people be passionate. Thank you so much for what you've done, Christine. You too.
Thanks so much, Laura. I can't thank you enough for being here today, Laura. I want you to leave us with one piece of advice if you can. So if you could give yourself in high school one piece of advice, what would it be?
Just read. I mean, because I think curiosity and reading are the two like biggest attributes that you need in the industry. You don't have to be a math superstar, you don't have to be the smartest person in the room, but just follow your curiosity and follow your passions, and I think you'll be successful in this business.
Excellent.
It's fun. I think you can tell from James, he's extraordinarily passionate. I love every minute of my job, even when I'm lagging on a melt up, but I love it. So I'd highly recommend it as a career.
Excellent. Well, thank you so much, Laura. I can't thank you enough for being here today. It was great to see you. James, thanks for joining us today. What a great surprise. Well, that's it for this week. So I will see you guys in 2 weeks. We're taking a little vacation for the holiday, but we'll be back again. So I'll see you guys all very soon.
Thank you.
Bye, guys. Thanks, Laura.
Bye.
Thank
Thank
you.
you.